It was a very good morning from him. Of course, it's a very good morning from me. I hope all is well with you. Welcome to my mortgage live stream. It's July. The kids have broken up. You probably noticed. We used to pop down to the M5 when I was younger with my kids when they were tiny, and we used to watch go onto the bridge and watch the M5 traffic stream down from the north down to the southwest every Saturday at the beginning of the school holidays. Remember when you were a kid, you had 6 weeks holiday. How cool was that? But you probably haven't got that, have you? Probably having to work like everybody else. Anyway, enough of that. Let's get on to mortgage updates, mortgage live streams. Let's give you some things that are happening, what's going on. Lots happened last week. We had the famous Mansion House speech from the Chancellor, and obviously everything's all leaked beforehand. But they're letting the gloves off with the mortgage market. They're letting lenders really lend more money to first-time buyers than ever before, and I think that's brilliant. I really do. I think lenders are very careful now in what they do lend. There's technology to help them not to overstretch people, but I think it's a great thing. More first-time buyers who've been paying rent for like years, like large amounts of rent, and not been able to save up so much for a deposit, get them out to the housing market. They can pay rent, they can pay a mortgage. And obviously interest rates will vary, but rent varies as well. So I think it's a great thing. I really do. But we'll wait and see what happens to the market, shall we, as things begin to change. Got a couple of topics for you today. We've got some changes going through on CeMAP right now, and I'll tell you a bit more about those at the end of the session today. But I want to do a little video clip on one of the new CeMAP content sections to go into. But then I want to take a look at the new government mortgage guarantee, because that came in last week as well. Not a lot of people really made a note of that, but it's really important, actually. I want to share that with you in my session today. So I hope all is well with you. I hope you're good. Hope you're enjoying yourself, getting busy. Remember, don't get busy. Make yourself more efficient busy, I think is the key, because it will get busy again. And you want to make sure that you can cope with that busyness and not to do all the extra pieces of work that brokers tend to do for clients and not charge for it either, which is unnecessary. Let's get into my first topic, which is main financial markets. What I want to talk about with you now then is the subject of the main financial markets. Who are the markets in the industry? What are the main ones? So let's pop over to my whiteboard, where I can talk these through with you for a few minutes. Main markets. Well, there's several markets in the industry that we need to be aware of. So let's just break them down into one by one. So the first one for you I want to talk about is the interbank market. Now, the interbank marketplace, and these are all markets, by the way, is essentially, it's not really a marketplace, you get like on a Friday afternoon in town, but it's the market where banks will lend to each other any surplus cash they've got. Hence it's called interbank market, which is a pretty good name, isn't it? So you've got a bank here, Bank A, for example, and you've got over here, you've got Bank B, because I can't think of any decent descriptions for these two banks, really. And they're banks and retail banks, and they're doing their trade. But overnight, Bank B has got surplus money. It's got plenty of money that it doesn't want to put with the Bank of England, but it wants to earn an interest, so it lends it to Bank A overnight, and it lends it at a particular interest rate. Now, it can be overnight, as I mentioned to you, but it can be sort of a 6-month lend as well. And it's pure cash, so they can use that money to lend out themselves. So that's the interbank marketplace, which keeps the whole thing moving along smoothly. As a result of that, we get interest rates created by the interbank market, not the Bank of England. They do their monthly meetings with their vol-au-vents and their lunches, don't they? But this is the interbank market. What happens here is they give you two interest rates you've probably come across. The first one, which is gone now, is what's called the LIBOR, the London Interbank Offered Rate, which kind of makes sense. It's the interbank, London, because that's what happens, offered rate is what that bank offers that bank for that overnight money. So LIBOR is not used so much anymore because it was rigged, really. Come on, in a second. So it's not used anymore, and it's been phased out now, and it's now called SONIA. We talked about this before on videos. SONIA, not a Liverpudlian singer. SONIA stands for Sterling Overnight Interest Average. And it's the interest rate, of course, that replaced LIBOR in 2022, because they were rigging that one. They can't rig that one. It's broadly what it is. So it's a rate of interest really that's the most up to date in the marketplace. Think about it. If Bank B lends to Bank A overnight and they charge them a rate of interest, say 4%, that's the most up to date market rate going, isn't it? Because the Bank of England rate's always a month old, isn't it? So SONIA is the one now that they use. So that's the interbank rate, which makes sense, isn't it? Interbank market. Okay, what else have we got? Well, we've got the big one over here, and I'll call this the stock market. Stock markets. Now, stock markets as a general term is where, of course, bonds and shares are marketed around the world. We've got different markets, come on to this in a second. So you've got this big building. There you go. Let's just put the stock market in there. We've got pillars, haven't we? They always put pillars in there and lots of steps and things like that. That's your stock market. It's not a building anymore as such, what it is, but it's more electronic and computerized now. Of course it is. What happens here? Well, in these markets, shares are bought and sold, and bonds are bought and sold. Bonds are government gilts issued by the government, but also corporate bonds as well, bought and sold on the marketplace. Now you have two types. You have primary markets. Let's put that in there. The primary market is where new stuff is issued, new shares are issued in the primary market. If a company wants to issue new shares, it can do. But you also have what's called the secondary market. That's the one we tend to deal with most of all, the secondary market. The secondary market is where second-hand shares effectively are bought and sold by dealers and people want to buy them, funds, unit trusts, funds, all those sort of things, buy and sell billions of shares on a daily basis. So you've got two types going on there. You've got your shares, equities, as we often call it, of course. Let's put the proper name for you. Or bonds. They're the two things that are transacted. An equity is a share. A bond is a government gilt, but also corporate bonds as well. They're government loans, effectively. That goes on as well. Now, what do we get from that? Well, we get a number of marketplaces across the world. The London Stock Exchange is the one that we're aware of course. You've got Dow Jones in the US. NASDAQ looks after the technology stuff, haven't it? You've got the DAX over in Germany. You've got the CAC over in France, the Hang Seng. You've got all sorts around the world. And different companies, you see, will list themselves in different stock markets. Since Brexit, we want companies to list themselves with the London Stock Exchange, but many are going over to Germany and obviously in New York as well. And we're beginning to lose a few firms in the London Stock Exchange, but it keeps the London market bubbling along nicely. It gives us prices of equities, of course, because when you've got a buyer and a seller, demand and supply determines the price. It gives you the price of bonds, and it's been in the market where bond prices have gone up or gone down. Obviously, they're going down at the moment, but then yields are going up. So it gives you all that activity in the marketplace. That's the stock markets. What else have we got? Let's get a different colour pen. Go back to the blue show. Over here, we'll put Forex in here for you. Forex. Now, the Forex is the foreign exchange market. That's where foreign exchange is bought and sold by people. So you might, for example, have sterling and you might want to buy dollars. So you basically convert your sterling into dollars and into euros or whatever currency you want. Why do you have a Forex market? Well, some firms, banks especially, need to have foreign exchange, for example, international trade. If you're dealing with China, you have to use their currency if you're buying products from them. If you're selling to America, the American banks will need pound sterling to pay for your services. I mean, I do quite a bit of trading in the US, which is great. I do it online. And they pay me in sterling because that's what I like. So they have to convert their dollars into sterling. So that company will need to go to their bank and get it exchanged. That's international trade is a massive area for the Forex market. But also it's investments. People actually do invest in the foreign exchange market. They think that Germany, the euro is going to do particularly well, so they might buy euros, and then the euro and the pound move in the right manner, and you make yourself some money from that. So a lot of people make money from trading in the Forex market, the foreign exchange market. The last one for you, and we'll squeeze it over here for you, is the insurance market, the insurance marketplace. Again, when we talk about markets, it's not necessarily like stalls and stuff, but in the insurance market, of course, you have insurance companies. and they involved in insuring risks for corporates and individuals, isn't it? Again, you have two types. You've got the primary insurance market. So that's your companies such as Legal and General and all the big firms that insure risks for firms and individuals. And of course, around the world as well, not just in here in the UK. But you've also got what they call the reinsurance market. You may have come across that. The reinsurance market is where one insurance company is unwilling to cover a particular risk because it's just too big. For example, you could have one of these great big cruise ships that they build now, like 30 stories tall ships they have now that sail off to Caribbean and dump thousands of tourists into these poor little towns. Yeah, these things cost a lot of money, and you might go to the market to be insured, and one company may not want to have the whole risk. It's too much. So they will reinsure it. In other words, use other insurance companies to take on that risk as well as them. So they're passing on. So if one of these things sunk, millions of people drowned, so lots of compensation payments, insurance payout was enormous. One company's not going to go bust because it's passed the risk on to several other insurers. Lloyd's of London come into their own as well. So that's the insurance market. So that, my friends, is the financial markets. Hope that's been useful. Bye. Hey, okay, that's good, isn't it? So what we're doing there is we're just giving you one or two new videos for the new FUSRI exam. Now, CeMAP 1 is changing in the autumn to become more complex, a level 4 exam. And the NIBF have put a new syllabus in for CeMAP 1 based around the FUSRI exam. So we're getting ours ready now. We're pretty much ready to launch by the end of this month, July. We've got revision guides, we've got podcasts, we've got test packs, and we've got the boot camp, which has all the videos. So we're just adding a few extra videos into the boot camp now so that if you want to do the new CeMAP 1, and there's dates, by the way, I'll tell you about a webinar in a second. There's dates that you need to be aware of if you want to transition over to the new one. So that's what that particular session was all about. The next session is just an update for you, really. And we'll put this into our boot camp as well, because that's what we do. We record videos all the time, new videos, put them into boot camp, so you know that you're always up to date, which is key, isn't it? Because customers expect you to be so. Now, in the Chancellor Exchequer last week, which talked about giving the mortgage market a bit of a boost, she also made the government mortgage guarantee scheme an element of permanency. So let's talk about the government's mortgage guarantee. Now, we've talked about mortgage guarantees many times before, and we know that, of course, they are designed to help people, help lenders to lend high loan to value on properties. In the past, let's just pop in so you can see me as well. In the past, they used to go to insurance companies and buy mortgage indemnity guarantees, didn't they? But over the last few years, the government's chipped in with its own guarantee scheme. But now they've made this new scheme permanent. So it's really good. So what I'm going to do now is just take you through the permanency of this thing, some of the rules and regulations. So let's just take a look at a nice little table that I put together. I think it'll be quite useful to explain how it all works. And on the left-hand side there, I've got the features and then the details for you as well. So let's take a look at this new government mortgage guarantee scheme, shall we? So when's the launch date? Well, it's this month, July 2025. It's been launched. So if you're watching this video later, it's been going on for a while now. What's the purpose? Well, the purpose really is to support home buyers who've got small deposits by encouraging lenders to offer 91 to 95% loan to value mortgages. Now, lenders do this anyway. We know that, but they're taking a risk. Because they're taking a risk, they charge high interest to offset that risk. But some of them may require some additional security from the government to help them if it all goes wrong. And the risk here is that prices of properties come down and the person's mortgage goes up and they're in negative equity when they have to be sold under repossession. So that's where they're going with that. So who's it for then? Well, you think it's for the first-time buyers. Well, it is essentially, but it's actually for the lender as well. But the lender benefits from this, but of course the first-time buyer and home movers get to benefit as well because they get a high loan to value mortgage. Notice it's not just first-time buyers, but they must be purchasing a residential property. There's no buy-to-lets going on here or anything like that, or investment properties. It's for normal people buying normal first or second homes for them to live in. Property value cap. Well, there's always a value cap at 600,000. It may go up, we don't know. But 600,000's a pretty reasonable cap for a first-time buyer or somebody moving to their first property or second property. Deposit requirement, well, minimum 5%. We're not talking about 100% mortgages here. That's a different world altogether. The lender will have to take that risk. We're talking about 95% mortgages, which of course have been the mainstay for first-time buyers for years. What loan types? Well, we're talking about repayment mortgages here. We don't do interest only on this basis, but how many people have interest only mortgages anymore? For first-time buyers, it doesn't happen, does it, anymore? Term, well, we've got 5 to 40 years. So it's the typical terms that people can have, of course. Occupancy. Let's get out of the way so you can see this. Let's pop up at the top there. Well, the property must be the borrower's main residence, not a second home or a buy-to-let. So they've got to be living there. That's really the key. Creditworthiness is the next one. Standard affordability and credit checks apply. So what we're saying there is that the lender will do their normal affordability calculations. It won't affect the lender's ability to do their calculations or credit checks. All's happening here is the government are providing an extra guarantee in case the lender needs to find some more money to cover the mortgage on a repossession. So what is this lender guarantee then? Let's talk about that. Well, three bullets there. The government guarantees a portion of the lender's losses if the property is repossessed. Nice description, that, isn't it? The exact amount guaranteed is not a fixed percentage of each loan, but is structured to cover a portion of the lender's losses in the event of repossession that nobody really knows. The total cap, though, on the government's contingency is 3.2 billion. So they're not going to overdo this. They're not stupid, are they? If there's a market collapse, for example, they'll be up for billions. So there is a maximum that the government will ever really guarantee here. But other than that, they've kept the numbers between themselves and the lenders as well. A couple more bits for you. Here we go. Scheme duration. Well, it's permanent now. It's not a temporary measure like the previous ones. And the lender's cost. What does it cost the lender? The lenders must pay a commercial fee to the government in exchange for the guarantee. The fee structure is tiered based on the loan to value ratio and the loan size. So the bigger the loan, the more the fee. And if it's an 80% mortgage or 85% mortgage, it'll be a lower fee. If it's a 95% mortgage, that'll be the higher fee. So the lenders will have to pay a fee to the government, not the borrower. That's changed from mortgage indemnities. So the lenders are going to have to compensate themselves. So they'll charge a high interest rate, which they currently do anyway. They might charge even more. And that's how they're covering themselves now on mortgage indemnities, by charging extra interest, which the borrower will pay over the term of the product. So that's a good little overview for you on the government's guarantee scheme. So I hope that's been a nice little update for you on what's going on in the world. Great stuff. Well done. Well done. Okay, let's finish off then with a little sales tip for you. As you know, I'm always doing my little sales tips, my little ideas to help you to run your business, because you are a mortgage advisor, financial advisor, and at the end of the day, we need to be human. We need to have soft skills. This one's called "It Was Like an Exam." Now, it was like an exam, she said. I was so much under pressure. You see, my daughter and her boyfriend are buying their second home in Scotland, so they're moving up the ladder. And their high street lender has called them in for a meeting at the branch to finalise their mortgage application. How old-fashioned is that? Now, Jess and Andy, they're very clever, and they've conducted tons of research online, and they both have a very good understanding of the process of mortgages. But even with this preparation, they struggled. They were bamboozled by the jargon that the advisor gave them, the in-house phrases she used. The questioning, they said, seemed like an interrogation, like an exam. And Jess said, she said to me, it came across as an exam, she said afterwards. Of course, that's not you, but then we all slip into groupthink or industry jargon. We use it all day and we forget the customer isn't in our world. They're in their own world. So what can this cause then? This can cause all sorts of issues. Mistrust between you and the customer. It can cause confused clients, bring out the client's vulnerable issues maybe. It can cause the wrong advice or recommendation is incorrect. It can cause a delayed decision from the client. It misses the human empathy connection that we find so vital these days, with the advent of AI, of course, doing most of our jobs. And ultimately, it can cause lost sales and lost business. So this is big stuff. Now, thankfully, Jess and Andy have me to back up their discussions. But even I slip into industry jargon because I train financial advisors every day in their language. I even had to rethink how I explain things carefully to Jess and Andy. Hope you found that useful. A nice little update there for you on a little sales skill. Makes you think about things, doesn't it, really, when it comes to it? Okay, quick update for you. As always, we've got our database for you to get on, and you might want to get onto our database more than ever before. So there's the database QR code, which you can jump onto and get. So just freeze the video and QR it as well. Because as I mentioned to you a couple of times, CeMAP is changing. They're going through some brilliant changes. I've got to take my hats off to them. They're updating it, they're enhancing it, they're making it more relevant to today's marketplace. They're making it tougher, which it should be, more in line with financial advisors now as well, which I think is a brilliant idea. So CeMAP 1, CeMAP 2 and CeMAP 3 are all undergoing massive changes. We're busy getting our stuff going on here, all our new materials, because there's a crossover, you see. You can do the old one, but you can start doing the new one at the same time. So you've got to make a decision which one you want to do, particularly if you're studying. So I'm running a webinar early August. We'll let people know what that date is. I think it's the 6th of August from memory. It's 6 o'clock in the evening for sort of 45 minutes. I'm doing a live video webinar where I shall explain the changes and let people answer questions about what's going on as well. So if you're on our database, we'll let you know when that is. We've got 100 people's seats ready, so you can come along and get yourself up to date. So you should go there, really, because it will affect you. Even if you've got your CeMAP, you might think, hold on, my people that I run a business for, they need to do some more CPD because they need to up their level of knowledge. Because that's what I would do if I was running a team of salespeople, wouldn't you? Other than that, that's it for me this week. I hope you've enjoyed it. We'll be back next week with some more goodies for you. Other than that, have fun, everybody, and we'll see you all again next week. Bye for now.